Friday, January 9th, 2026 is not an ordinary market date. This is the kind of date professionals circle quietly, because forced selling does not announce itself loudly. It arrives through rules, not emotions. Roughly $14 billion in gold and silver positions must be sold. This is not speculation. This is a mandatory rebalance. Institutional funds have no flexibility here. They must sell within a fixed window. That window opens after Thursday's close. By Friday morning, pressure hits the market. Silver recently traded above $83 per ounce. Today, it is hovering near $78. That move alone has changed sentiment. But the price drop is not the full story. Paper contracts are flooding the market. At the same time, physical silver is disappearing. Dealers are running out of inventory. Bars that shipped in days now take weeks. Premiums are rising even as spot prices fall. Two markets are forming at once. One trades digital promises, the other trades real metal. They are no longer moving together. This kind of divergence breaks traditional logic, because price says one thing, availability says another. When paper supply increases but physical supply vanishes, something inside the system is stressed. Most retail investors are watching charts. Very few are watching structure. This week is not about guessing direction. It is about understanding mechanics. What happens next will not just affect silver. It will ripple through currency confidence, through inflation expectations, through long-term wealth protection, and through how markets price reality. In the next part, we will break down why this forced selling exists and why it does not mean demand is weakening. The selling pressure coming into this market is structural. It has nothing to do with fear or confidence. It comes from index rules written years ago. When silver surged more than 150% in 2025, index allocations broke balance. Commodity indexes cannot let one asset dominate weight, so positions must be reduced, not slowly, not strategically, but mechanically. The Bloomberg Commodity Index faces that rule now. Roughly $7.1 billion in silver exposure must be sold. Another $7 billion in gold must also be reduced. That totals more than $14 billion entering the market quickly. This is not discretionary trading. No one is analyzing charts before selling. No one is waiting for better prices. The sale happens regardless of conditions. This is why the timing matters more than sentiment. Selling begins after Thursday's close. Liquidity will be thinner. That amplifies impact. Friday morning becomes critical. Short-term volatility is almost guaranteed, but volatility does not equal weakness. It often exposes hidden strength, especially when demand exists elsewhere, because this selling happens in paper markets, futures contracts, ETF shares, derivative exposure, not physical bars, not real inventory. No silver moves from vaults during this process. Only ownership claims change. That distinction is everything. While paper supply increases, physical supply does not. In fact, physical availability is shrinking. Major dealers are already sold out. Delivery timelines are extending. Premiums are widening. This tells us demand is not fading. It is intensifying. Buyers are waiting, not sellers, waiting for price disruption. This is why forced selling can create opportunity, but only for those who understand structure. In the next part, we'll look at why physical silver is becoming harder to find, and why price drops may not translate into real buying opportunities. The physical silver market is telling a very different story. Dealers are not reacting like a normal correction. Inventory is not rebuilding, it is disappearing. Popular silver bars are already marked, sold out. Shipping dates are being pushed weeks ahead. Some products are only available on pre-order. This is not demand slowing, this is supply stress. Premiums explain it clearly. Spot silver trades near 78. Physical buyers are paying 85 or more. That gap matters. It means price discovery is breaking. Paper price says one thing, physical availability says another. This has happened before. In 2020, paper silver fell below 12. Physical silver never followed. Coins sold for 25 to 30. Markets decoupled completely. Today looks similar, but with one key difference. Refineries are already maxed out. There is no idle capacity. Scrap silver is being melted aggressively. Even that is not enough. Industrial demand is absorbing supply. Solar panels consume massive volume. Electric vehicles require more silver than combustion cars. AI data centers add another layer of demand. None of this demand is optional. It does not pause for price drops. This makes supply inelastic. When buyers rush in, metal does not appear. Dealers respond by raising premiums, not lowering prices. So if paper silver drops Friday, physical prices may barely move, or premiums may expand further. That creates a paradox, a falling price that costs the same to buy. This confuses most investors because they assume spot equals value. It no longer does. Value is being set by availability, not screens. This is why understanding structure matters, not charts alone. In the next part, we'll break down why this divergence is happening now and how geopolitics and monetary pressure are feeding it. This divergence is not accidental. It is driven by geopolitics. and by monetary stress. January 2026 is not a calm period globally. Power blocks are shifting. Rules are being tested. Assets are being weaponized. This changes investor behavior. When assets can be frozen, when accounts can be restricted, trust in paper weakens, hard assets gain relevance. Silver benefits directly from the shift. Because it sits between money and industry. Gold is purely monetary. Silver is functional. It powers infrastructure. It supports technology. It enables energy transitions. This makes it strategic. Recent geopolitical moves confirm this. Shipping routes are under pressure. Energy assets are being seized. Sanctions are expanding. Trade flows are fragmenting. Each disruption increases demand for neutral assets. Silver does not belong to any government. It does not rely on permission. It cannot be printed. That matters more now than before. At the same time, monetary policy is cornered. Debt levels are historic. Servicing costs are rising. Growth is slowing. This limits central bank options. They cannot tighten aggressively. They cannot tolerate defaults. They choose liquidity, always. That liquidity weakens currencies. It lifts hard assets. Silver responds faster than gold because its market is smaller, because its supply is tighter, because its demand is industrial. This is why volatility increases first, not because silver is risky, because silver reacts early. Paper markets react to policy expectations. Physical markets react to reality. Right now, reality favors scarcity, and scarcity favors holders, not traders. This sets the stage for what happens next, because forced selling meets strategic buying, and history shows who wins. In the next part, we'll look at who is absorbing supply quietly and why this matters more than price this week. While headlines focus on price, the real story is positioning. Smart capital moves quietly. It does not announce entries. It accumulates during confusion. Recent data shows this clearly. Exchange inventories are declining, not gradually, consistently. This is not retail behavior. Retail reacts emotionally. Institutions act methodically. They buy when liquidity appears. Forced selling creates liquidity. That is not weakness. That is opportunity. This pattern has appeared before in oil markets, in bond markets, and currency resets. Paper pressure flushes weak hands. Strong hands absorb supply. Silver fits this pattern perfectly because paper volume is large, but physical float is small. Once physical is locked, price discovery changes. This is why premiums expand, not because dealers are greedy, because replacement cost rises. When inventory cannot be replenished, pricing disconnects. This is not theoretical. It already happened. Dealers delay deliveries. Bars move to pre-sale. Premiums detach from spot. This signals stress, not panic. Stress precedes repricing. At the same time, industrial demand does not pause. Solar manufacturing continues. EV production expands. Data centers scale. These processes are not optional. They are policy-driven. They are capital-committed. Silver consumption continues regardless of price. This creates a floor. Paper markets can break temporarily. Physical demand rebuilds price. This is why dips do not last. They transfer ownership from short-term traders to long-term holders. That transfer is irreversible because industrial silver is consumed, investment silver is hoarded. Neither returns quickly. This tightens the system further, which increases sensitivity. Future shocks move price faster and further. This is why volatility expands upward after compression. The current phase is compression, not distribution. Distribution happens at euphoria. We are not there. Sentiment remains divided. That is bullish. When consensus forms, opportunity disappears. Next, we need to understand psychology, because price alone does not drive markets. Behavior does. And silver behavior is changing. In the next part, we break down investor psychology and why most people exit at the worst moment. Most losses are psychological, not analytical. People do not fail on data. They fail on timing. Timing fails because of emotion. Fear enters after volatility. Greed enters after confirmation. Both arrive too late. This cycle repeats endlessly. Silver amplifies this effect because moves are sharp and pullbacks are violent. This creates hesitation. Hesitation creates regret. Regret creates poor decisions. The first mistake is chasing strength. Buying after headlines appear. Buying after social confirmation. By then, risk is highest. The second mistake is panic selling. Selling during forced drops. Selling during structural events. Mistaking mechanics for fundamentals. This error is common because paper price feels real, but paper price is transient. The third mistake is overtrading. Constant position adjustment. Reacting to every candle. This erodes conviction. Conviction is required in scarcity assets. Silver is a scarcity asset. Its supply is not elastic. Psychology ignores this fact. The fourth mistake is comparing past tops. Assuming repetition without context, ignoring monetary expansion, ignoring industrial dependency, ignoring geopolitical shifts. History rhymes, but does not copy. The fifth mistake is waiting for certainty. Certainty never comes early. It arrives after repricing. By then, upside is limited. Markets reward early discomfort. Comfort signals maturity. Maturity signals risk. Silver discomfort remains high. That indicates early phase. Another psychological trap is anchoring. Anchoring to old prices. Anchoring to outdated ratios. Anchoring to narratives that expired. Markets do not respect anchors. They respect flow. Capital flow is changing direction. Physical flow is tightening. Paper flow is unstable. This split confuses investors. Confusion creates opportunity, but only for the patient. Most people want clarity. Markets offer uncertainty. Those who accept uncertainty gain asymmetric reward. Silver is offering asymmetry now. Limited downside structurally. Open-ended upside psychologically. This is rare and uncomfortable, which is why it works. In the next part, we connect this psychology to historical transitions, where similar patterns played out, and why outcomes were inevitable. History does not repeat mechanically. It repeats behaviorally. Markets change form. Every major repricing followed this pattern. First disbelief, then forced acceptance. Evidence is everywhere. Price action confuses participants. Headlines conflict daily. Experts disagree publicly. This is not weakness. In past cycles, this phase mattered most, because positioning occurred here, not at extremes. Assets stayed ignored for years, then broke structural ranges. Pullbacks followed. Media declared failure. Smart capital accumulated quietly. Then repricing accelerated. This pattern is universal. Oil experienced this behavior. Copper experienced it. Gold experienced it. Even equities followed it. Silver's difference is leverage, both industrial and monetary. That dual role creates tension. Tension creates volatility. Volatility scares participants. Scared participants exit early. History shows this clearly. Repricing phases punish impatience. They reward endurance. Another historical lesson is duration. Large base formations take time, but moves after bases are fast. Silver built a multi-decade base, not months, not years, decades. When such bases resolve, they do not retrace deeply. They pause, they rotate, they shake confidence, then continue. Past examples show this. The strongest rallies emerged after boredom returned, after attention faded, after conviction weakened. We are approaching that zone. Attention is shifting. Media is moving on. Retail enthusiasm cooled. That is constructive. Another historical signal is institutional confusion. When institutions disagree, markets are not finished. Consensus appears near endings. Disagreement appears near beginnings. Current forecasts vary wildly. That confirms uncertainty. Uncertainty equals opportunity. Most participants misread this. They seek agreement. Markets offer disagreement. Those who wait for agreement miss repricing. Another lesson is policy lag. Central banks react late. They respond to damage, not prevention. Markets front-run policy. Silver reflects this now. Policy is tightening, but liquidity stress is rising. That mismatch resolves forcefully. Historically, it resolves upward, especially for hard assets. This transition is rarely smooth. Volatility increases first, then clarity appears, then acceleration begins. Silver has not accelerated yet. That alone is information, because fundamentals already justify it. When price lags fundamentals, pressure builds. Eventually, release occurs. History confirms this repeatedly. The next part explains where pressure releases first, and why physical markets lead paper markets. That distinction decides outcomes. Physical markets speak slower, but they speak truthfully. Paper markets speak loudly, but they exaggerate. This difference matters now, because divergence is widening. Contracts trade instantly, metal does not. Promises change hands, bars change ownership. That distinction defines value. When liquidity tightens, paper absorbs stress first, physical resists pressure longer. This is not theory. It is observable behavior. Vault withdrawals increase quietly. Delivery times stretch silently. Premiums expand gradually. Spot prices ignore it. That disconnect confuses traders, but it informs accumulators. When physical availability shrinks, price discovery breaks, screens stop reflecting reality. Reality moves offline. This has happened before. It always ends the same. Paper follows physical eventually, not the other way around. Short-term volatility hides this. Long-term resolution reveals it. Current conditions match that phase. Inventories are thinning. Refining capacity is constrained. Logistics remain fragile. Demand does not pause. Industrial usage continues. Energy transition requires metal. Technology expansion consumes metal. Monetary uncertainty protects metal. These forces do not reverse quickly. They compound over time. Paper selling creates noise. Physical buying creates floor. Noise fades. Floors remain. That is why corrections stall. That is why rebounds surprise. Most traders focus on charts. Few study supply chains. Charts react. Supply dictates. Those who understand this position differently. They do not chase, they do not panic, they observe availability, they track delivery friction, they notice premiums, they read absence. Absence is information, silence is signal. Market is not weak, it is separating layers. Paper volatility above, physical scarcity below. Eventually layers reconnect. When they do, price adjusts violently. That adjustment rarely warns. It arrives suddenly. That moment is not forecasted. It is triggered. Triggers come from stress. Stress is building quietly. The next part explains what triggers convergence and why timing never looks obvious beforehand. Markets do not move randomly. They react to pressure points. Pressure builds invisibly until something breaks. Triggers are rarely headlines. They are mechanisms, forced actions, structural deadlines, liquidity mismatches. This week contains one. Rebalancing is not opinion. It is obligation. Indexes do not wait. They execute, regardless of sentiment, regardless of positioning, regardless of consequences. That is why this matters. Selling is scheduled. Buying is optional. Optional behavior hesitates. Mandatory behavior does not. This imbalance creates volatility. Volatility exposes weakness. Weakness reveals truth. Truth surfaces fast. When forced selling begins, algorithms amplify movement. Stops trigger automatically. Leverage unwinds mechanically. Speed increases. Emotion follows. Retail reacts last. That is always the order. But here's the difference. This time, supply is thin, not on screens, in vaults. When selling hits paper and buying hits physical, markets split, price discovery fractures. One side moves down, the other refuses. That refusal is signal, because refusal costs money. Premiums rise despite drops. Availability tightens despite fear. That is not normal. That is structural. This is how convergence starts. Not with news, with friction. When friction increases, systems strain. Strain exposes leverage. Leverage fails first. Physical holders do not. They already paid. They already hold. They are not forced. That asymmetry defines outcome. Short-term chaos appears. Long-term direction clarifies. Most people focus on candles. Few track obligations. Obligations move markets. This week contains one. The next part explains who gets hurt first and why retail usually reacts too late. Markets always test belief. Not at the top, at the pause. This week is that pause. Paper pressure is temporary. Structural demand is not. That difference matters. Short-term selling creates noise. Long-term holders create floors. Floors are not announced. They are discovered. When price drops, but supply does not return. When fear rises, but inventory stays tight. That is the signal. Not charts, not predictions. Behavior. Silver is not reacting to hype. It is reacting to structure, debt expansion, energy transition, technology demand, monetary pressure. These forces do not reverse weekly. They compound. Corrections reset momentum. They do not erase trends. Those who understand this, wait. Those who don't, panic. History is clear on this. Paper shakes hands, physical changes, ownership. That transfer decides cycles, not headlines, not influencers. This is not about timing tops or calling bottoms. It is about understanding phase. Silver is no longer ignored. It is being tested, and tests strengthen trends. This phase ends quietly. The next move will not. That is how markets work.